When we talk of sensitivity analysis, ladies and gentlemen, like now here, sensitivity analysis of what here? Of sales. What am I supposed to remember here? To get sensitivity analysis of sales, the first thing that I would need is the present value of sales. That item that they would want us to ascertain its sensitivity analysis would want to discount it. So first of all, give me the present value of the sales. Yes, so give me the present value of sales here. Give me the present value of sales. So the present value of sales, then this automatically will be the sales amount that we have here, which is 500 times PV times present value interest factor of an annuity. Why am I using present value interest factor of an annuity? I'm using present value interest factor of an annuity simply because the sales amount given is an annual figure. I'll enjoy this 500 I'll enjoy this 500, ladies and gentlemen, I will enjoy the 500 every year for how many years? For 10 years. 500 every year for 10 years, like that. So then I would want to get here present value, interest factor of an annuity, ladies and gentlemen, here, of an annuity here, of for 10%, how many years? 10 years. And I believe this one is in your tables. If you go to your annuity tables, you'll be able to get PV for 10%, 10 years. Is there somebody who can give me that figure? Right? 61446, 61446, 61446, like that decimal there from your annuity tables. Thank you so much. So meaning, ladies and gentlemen, that my present value of sales will be the sales amount here, which is 500 times this 61446 decimal. So then this one here will end up giving me what amount? From Steve, we are getting 30. From Steve, we are getting 30, 3072.28, 3072.28, 3072.28. From Steve, you're getting 3072.3. Now, after that, you must have seen Alice giving us a very good formula. Alice has told us that sensitivity analysis of sales will be equal to the NPV of the project, NPV of the project, NPV of the project. So sensitivity analysis of sales will be equal to the NPV of the project divided by present value of sales. Present value of sales divided by present value of sales. So anytime they want us to give them sensitivity analysis of sales, what do? We start by taking the net present value of the project. You take the net present value of the project, which in this particular case is 10,000. So I will take 10,000 divided by the present value of sales. Present value of sales, you guys have given me what figure here? 30 what here? 3072. 3072.3. 3072.3. So could you kindly give me this figure? Inakuja ngapi? Inakuja ngapi? Inakuja 3.25. So it is 3.25 in terms of percent. This will be 325%. This will be 325%. Is there somebody who got this answer correctly? Is there somebody who got this answer correctly? Is there somebody who got this answer correctly? Irene Odenyi, yes. Lucy, yes. Yes. Thank you so much. So 325%. So can I go straight away to sensitivity analysis of variable cost? Can I go to sensitivity analysis of variable cost? Yes. So when they want me to give them sensitivity analysis of a variable cost, then the first thing that I will do is to get the present value of variable cost. So come and give us the present value of variable cost. So give us here the present value of variable cost. So this will be 700 times the same PV that we got up there. So this will be 700 times 614.46 with a decimal there. Can somebody give me a figure there? 700 times 6.1446, like that. Can somebody give me this figure? Can somebody give me this figure? Wanasema abracadabra David Kashero 4301. 4301.26. 4301.22. Thank you so much. So once I get this, really getting now sensitivity analysis becomes a very easy task, as easy as a walk in the park, as easy as a walk in the park, as easy as a walk in the park. So in this case here, we have sensitivity analysis of VC. This will be net present value all over present value of VC, where VC stands for Vice Chancellor. VC stands for variable cost. Variable cost. So remember that our net present value still stands at what here, somebody? This still stands at 10,000. All over the present value of variable cost, which will be 4301.22. Whatever I get times 100, whatever I get times 100, whatever I get times 100. So when I multiply this with 100, then somebody is telling me that I'm going to get 232 what year? 232%, 232 point something percent. So now can I go to a real question now? You know, this was a fake question. Who will give you net present value, not unless you have your own father working at CASNEB? Who will give you net present value? Who will give you net present value? No, no way. What they will do, and they have done this severally, these guys will come and they give you something that looks like this. Let me show you what they will do. Yeah. These guys will come and they give you something like this. So are you able to see my screen? Are you able to see this beautiful lady? White lady. They're not yet confirming whether they're able to see the book. Yes, thank you very much. Great, great. So I know you have this book. So you go to question number 46. You go to question number 46. You go to question number 46. Question number 46. Question number 46. Nope. It's question 47. Question 47. Question 47. Right? Question 47 is here. You can see part A. I only want us to do part A. I only want us to do part A. And I've repeated this twice. This is the second time I'm doing this same question. Second time I'm doing this same question. How I wish I was an examiner. I'm dreaming. I'll also become an examiner. No, I'm too old now. I'm too old now. But what I can't do is being that guy at the back of what year? A garbage truck. I can't do that. I can't do that. So now we are doing question number 47, part A. Question number 47, part A. So we read together, ladies and gentlemen, we're reading this together. They want us to evaluate the sensitivity of the project's net present value to a change in the following variables. To a change in the following variables. We are told the TAM company is considering investing $50,000 in a new machine with an expected life of 5 years. The machine will have no scrap value at the end of the 5 years. It is expected that 20,000 units will be sold each year at a selling price of 3 per unit. Variable costs are expected to be 1.65 per unit, while incremental fixed costs, mainly the wages of a maintenance engineer, are expected to be 10,000 per year. Town company uses a discount rate of 12% for investment appraisal purposes. So they want me to evaluate the sensitivity analysis of the project. And then the very first thing that I'll do once I hear the word sensitivity analysis is to compute the net present value of the project. That is the first thing that I will do. So I would want to remain silent a little bit to see whether there is anybody who will be able to give me the net present value of this project. So I can see chats are coming in. Thanks. Please keep on having those chats coming in. Okay, don't worry. Somebody should be able to share this book in our group. I know you guys have this book, so please, you don't even have to let me know. I can share it very fast. I have it. I have it. I have it. I have it. I have this. Page, Josephine Watamba, it's written here, page number 38. So page 39, right? Let's do it together. I have the honesty that my students normally come with. So they're telling me, Mwalimu, this net present value, you have to do it, no problem. So you see, ladies and gentlemen, what you're supposed to do here is basically get the profit. I can see there is price, I can see there is variable cost, I can see there is quantity, I can see there is what here fixed cost. So a good student should be able to reason these out in which context? Management accounting context, where we talk of profit for pi equals price minus variable cost, in this case here multiplied by number of units, minus fixed cost. Minus fixed cost. Profit is the price they've given you minus variable cost times number of units minus fixed cost. So are you able to remind Mwalimu what the selling price is? What the selling price is? What is our selling price? What is our selling price? What is our selling price? Lily tells me it is 3. Have they given me variable cost per unit? Have they given me variable cost per unit? It is 1.65. How about quantity? You know, X is quantity. Do you know what the quantity is that will be sold every year? It is 20,000. How about the incremental fixed cost per annum? The incremental fixed cost per annum will be what here, somebody? Incremental fixed cost per annum is 10,000. Thank you so much. So then this profit, ladies and gentlemen, will be a profit of how much? 17,000, right? So the profit here will be 17,000. The profit here will be 17,000. It's an annual profit. Now, ladies and gentlemen, have these guys given me taxation? Remember, first of all, that the profit that you get here automatically will be profit before depreciation and tax. So have they given me tax? This profit is profit before depreciation and tax. So when you are not given tax, what should you always think about? When tax is not given, you should always think about, thank you very much. When you're not given tax, if there is no tax, automatically depreciation is irrelevant. If there is no tax, the profit that you have here is your cash flow. So this is your cash flow. That's your cash flow. So then that means automatically I should go ahead and do what here? And a discount. So discounting, have they given me the COC? Have they given me the cost of capital? Have they given me the cost of capital? Yeah, 12%, isn't it? Do you know the number of years? Do you know the number of years? 5 years. So it means that for me to be able to get the present, so this is the cash flow, so come and give me the net present value. The net present value will be the cash flow here, which is 17,000 times PV for present value, interest of an annuity, 12%. How many years? 5 years, minus the initial outlay. Because here there is no scrap. They told us in the question that there is no scrap. So then we need to know, all of us, how to read these annuity tables. So I would want, and please don't assume, open up your annuity tables from one of your past papers. It's called the annuity. Go to that particular table, annuity table, go to where you are able to see 12% vis-a-vis 5 years and read for me. This one, everybody must have to do this. Everybody must do this, and everybody must give me an answer here. Everybody must give me an answer here. Go to the annuity table. Do we have, could you kindly do me a favor? Is it possible you share one past paper which has got those tables at the back? Please, in the two groups, somebody please do me a favor, get one past paper and share that past paper that has got an annuity table to the two groups. Yeah, from calculator, it is 3.6048. But remember, Babake, we don't go to the calculator when we are given a percentage that is available on the table for purpose of saving time, right? For purpose of saving time, right? So then this PV for 12%, 5 years, all of them, they are telling me it is 360, 48, 360, 48 with a decimal there. Thank you so much. So meaning that my net present value will be equal to 17,000 times the PV for 360, 48 minus the initial outlay. So have they given us the initial outlay? $50,000. The initial outlay, the initial cost of procuring this system is $50,000. Thank you so much. So then this one will end up giving us what net present value? What net present value? It is 11,281.6. It is 11,281.6. Even if I'm not asked, whenever I get a positive net present value, I must always write something inside there. Whenever I get a positive net present, even if I'm not asked, to demonstrate both broad and deep understanding of the subject, whenever I get a positive net present value, I know that the project is what here is variable. The project is variable. So I write like that, and a good examiner can easily give me 1 mark. And you see, 1 mark means everything to you. 1 mark can make you see places that you've never seen before. Variable. 1 mark can make you see places. Thank you very much. Variable. Now from there, ladies and gentlemen, remember that is step number 1. Now step number 2, I will ask myself, this guy wants me to carry out some sensitivity analysis. And the first one that he wants me to really look at is sensitivity analysis of volume. He wants me to look at sensitivity analysis of volume. He wants me to get sensitivity analysis of sales volume. Are you able to tell me what I need to do here, really? Is there somebody who can tell me what I need to do here really? Is there somebody who can tell me what I need to do here really? Please talk to me. What do I need to do really? What do I need to do? What do I need to do? What do I need to do? Okay, so for sales volume, ladies and gentlemen, sales volume, I need to get present value of the total contribution. You can't give me present value of volume. No, you go on, no, because you see, volume is number of units. And the present value has to be in terms of, the present value has to be in terms of what here? Money. So whenever they want you to get sales volume sensitivity analysis, they want you to carry out sensitivity analysis of total contribution. If I were you, I would have written that thing somewhere in my mother tongue. That sensitivity analysis of sales volume is equivalent to sensitivity analysis of total contribution. So then the first thing that I need to do is to come and give my examiner the total contribution here. Give my examiner the total contribution. Do you guys know how we normally get our total contribution? How do we get our total contribution? To get total contribution, this is so easy. To get total contribution, we take P minus V multiplied by what here? By number of units. Because total contribution is contribution per unit times number of units. Is there somebody who can remember? Don't remind me because I remember it's 3 minus 1.6 per multiplied by 20,000 was the volume. So then this at the end of the day will give me how many? This will give me how much as the total contribution. Please use your body mass very well. Open brackets. So Gordon Ware tells me that this is 27,000, the same case with Gracie, 27,000. Thank you very much. So then I would need to get the present value of the total contribution. I would need to get the present value of contribution. So this total present value of total contribution will be the 27,000 times the PV4. So I will not need to calculate PV4 again because I already have this figure. It is 27,000 times the 360. How does this look like? I've forgotten this figure. It was 3.6 something. It was 3.6 something. This PV4, you don't keep on computing them again. We computed it. 360.48. Thank you so much. 360.48 with a decimal here. So could you kindly give me this present value of the contribution? Present value of the contribution. Jackie tells me it is 97,329. It is 97,329.6 like that. 97,329.6 like that. Thank you very much. So then how do I get my sensitivity analysis? So to get my South Africa SA of contribution, which is the same as a sensitivity analysis of volume, what I'll need to do is to come and compute this by taking net present value all over present value of contribution. Present value of contribution. So the net present value, ladies and gentlemen, the net present value that we have, I've forgotten the figure that you guys gave me. For net present value, for sure, I have forgotten the figure. For sure, I have forgotten the figure. For sure, I've forgotten the figure. It is 11,281, 11,281.6. Divide this by the present value of contribution. Present value of contribution is 97,329.6 like that times 100. 0 point something, isn't it? So of course, change this to percentage. So you're getting 11.59. Oh, yay! 11.59%. Thank you so much. So that is a fast sensitivity analysis. If you guys were to be very honest with me tonight, if you got this kind of a question in an exam, how many of us would have gotten this correctly? How many of us would have caught this up? Live. Now, Mimi, great. Halfway, Sherilyn. Then you guys are bright. If you're able to remember that, ladies and gentlemen, sensitivity analysis of volume is the same as sensitivity analysis of contribution, for sure. You're bright. Thank you. Now, how about this other one? And you can check. Remember, you have the answers. Remember, you have the answers. Yours is basically to come and look at this. You can see sensitivity analysis of sales volume. You said it's 11.6, 11.59. They are getting 11.6. 11.6. So is that clear? Is that clear? Is that clear for all of us? Is that clear for all of us? Right? Right. Thank you so much. Thank you so much. Then now we can go straight away to the sensitivity analysis of the sales price. So could you kindly give me sensitivity analysis of the sales price? When these examiners, in this case here, want you to go to hell, they want you to miss the bus going to Casneb. They'll try to trick you guys here and there. So like now when they use this terminology, sensitivity analysis of sales price, they know for sure that there is somebody who will not be able to make it to passing. They know that. Some people will be left out. They know that, right? So I'm giving you 2 minutes to try this sensitivity analysis of sales price. What do we have there? Sensitivity analysis of sales price. And then remember the way these questions are framed, you're supposed to do them in 2 minutes. The moment you realize like you're taking like a whole 30 minutes to do computations here and there, that is not advanced financial management. Advanced financial management, maximum number of minutes you can stay in a question is 5, 10. If it's a money market question, like I saw somebody doing a money market question for more than an hour, what are you writing there? You're writing there what can't help you. You'd rather even go home before the examination time is over. It's a 5 minute thing, right? If it goes to the very highest, then 10 minutes, right? Right? Okay, so according to Grace, we are getting 5.22, 5.52. I think my data, that must be typing error. Susan Mwende has been very consistent in answering questions. The same with Sabrina, very consistent. The same with Macharia, the man who was refused to disclose the agenda, but we shall overcome, right? So these students have known that there is no way in advanced financial management you can ever get like a sensitivity analysis of just price of one item. It has to be sensitivity analysis of sales revenue. So this must be sensitivity analysis of sales revenue. This must be sensitivity analysis of sales revenue. Sensitivity analysis of sales revenue. So sensitivity analysis of sales revenue is the same as sensitivity analysis of selling price. So then the first thing that I'll have to do here is to come and calculate the total sales revenue, which is price times number of units. The price here is 3. Number of units are 20,000. So this gives me 60,000 like that. Once I have this, then I'll be able to, this 20,000 is an annual thing. It's an annual thing every year. I'll be enjoying this revenue every year. So it's a PV thing. It's a present value interest factor of an annuity thing. So it means that for me to be able to get the present value of sales revenue, then I'll take the 60,000 times the PV for. The PV for you guys had given me this figure. Unfortunately, I think it's 30, 360, 48, like that. Yes. So could you kindly give me this figure? 60,000 times 3.6048. So this gives me 216, 288. 216, 288. 216, 288. 216, 288, like that. Great. This is a tick. From there, come and give us this. Remember, this will be NPV over present value of sales. So then this one here will be NPV. NPV was 11. NPV, you can remind us the NPV. I don't have to keep so many things in my head. No. The NPV, the NPV, the NPV, the NPV, 11 to 81.6. Thank you very much. To 81.6. All of a present value of this, which is 216, 288, whatever I get times 100. So I should be able to get that sensitivity analysis. Which is 5.22. And I'm so happy because all of us got that correctly. All of us really got that correctly. So it's here. You can see the sensitivity analysis of this. It's 5.2. So for variable cost, the answer is 9.5%. I can see Lucy never got this right. Lucy gave me one for, Lucy, I don't know where you went wrong. Lucy is saying 104.3. You must have messed up, Lucy, somewhere. So I'm giving you a minute to try getting the sensitivity analysis of variable cost. Please try, and then we get to see. Sensitivity analysis of variable cost. What do we have there? So I've got videos of mergers and acquisitions. What I don't know is whether we wait for you guys, first of all, to finish these ones of financing decisions, or I send them. I think there will be too many for you guys. I don't know what to do. Because this thing is very procedural. We need to get like, now we are good with international finance, not 100%, but at least you're somewhere, right? Then now here we are looking at this capital budgeting, right? Capital budgeting, we have this sensitivity analysis, very common in our exams, decision tree, and I've seen somebody who knows something there. But you have to do this capital budgeting, the concept of linear programming that I'll do. From there, of course, I'm still on this mass of what here, financing decisions, of which I'll do 2 questions, good questions. After you guys have watched all those videos, I'll only do 2 questions here. From there, I go to mergers and what here, acquisitions. From there, straight away, I'll embark on this financial distress, right? Financial distress, right? Then, of course, on top of the real estate that I gave you the other time, I'll be able to come and do like one session for real estate. And then, of course, we have got emerging issues in finance. Like right now, we have got a lot of global warmth in terms of what here, in terms of, inflation, global inflation. It has never happened before, right? Effects on our economy being brought around by what here? So many things. COVID-19, right? Russia-Ukraine war, right? Like the lady that is here from Dubai tells me that a liter of petrol in Dubai some few months ago was going for 28 shillings. Right now, it's going for 130. Look at that spike, right? Actually, she told me, and I would want, although I've seen she doesn't want to speak here, she told me that, you guys in Kenya are in heaven. If you look at what is happening outside there in terms of inflation, things outside there, like in America, a liter of petrol is going for over 300 Kenya shillings. So then if it's Ukraine and Russia that have given, who have let the hell loose globally, why can't all these countries, in this case here, team and talk to these two great neighbors who are members of USSR some time back, the Soviet Union, right? So that they can cease fire for us to get into what year, back into where we were. Of course, not forgetting also that still COVID-19 is with us and the cases are spiking up, especially outside there. Things are not that nice, right? So emerging issues, COVID-19, emerging issues. I'll be able to talk about quite a lot about those things, but let's cross the bridge when we reach there. Great. I can see 18 new messages. 9.48. Thank you so much. And this one, what they're telling me is that I should not do this one at all. All of us are comfortable. True? All of us got 9.48. True? Yes. Yes. Shirley says, do it. Then Shirley, there must be a concept you guys have not yet picked. There must be a concept you guys haven't yet picked. This is very easy. When they tell me to give them sensitivity analysis of variable cost, number one, give them the total variable cost. 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 Yep. So come here, ladies and gentlemen. First of all, give us the total variable cost. So the total variable cost is variable cost per unit times number of units. The variable cost per unit is 1.65. Number of units are 20,000. So ladies and gentlemen, this gave you what figure? $33,000. Thank you very much. So, and then discount this, multiply this with PV firm. So this will be 33,000 times 360, 48. So decimal there. So then at the end of the day, what figure do we have here? What figure do we have there? Right, 118,958. So 118,958.4, like that. Now, once I have this, then I'll be able to give you sensitivity analysis of VC, which will be net present value over present value of VC, right? So the net NPV, you guys are giving me a figure of 11. I'm forgetting this figure quite often. 11,281.6, 281.6 divided by this, the present value, this one here, 11,895.8.4, like that, times 100. So what figure are we getting there, somebody? Yeah, very good, very good. Now, the other question that I would want you guys to do, please don't take this for granted.